Chuck Prince of Citibank famously said that we have to dance until the music stops. Actually, the music had stopped already when he said that.
The market for CDOs collapsed, leaving the investment banks holding hundreds of billions of dollars in loans, CDOs, and real estate they couldn't sell.
When the crisis started, both the Bush administration and the Federal Reserve were totally behind the curve. They did not understand the extent of it.
At what point do you remember thinking for the first time, this is dangerous, this is bad?
I remember very well I think it was a G7 meeting of February 2008, and I remember discussing the issue with Hank Paulson, and I clearly remember telling Hank, we are watching this tsunami coming, and you just proposing that we ask which swimming costume we're going to put on.
What was his response? What was his feeling?
Things are pretty much under control. Yes, we are looking at this situation carefully, and yeah, it's under control.
We're going to keep growing, okay? And obviously, I'll say it: if you're growing, you're not in recession, right? I mean, we all know that.
In a matter of days, one of the pillars of Wall Street...
In March of 2008, the investment bank Bear Stearns ran out of cash and was acquired for $2 a share by J.P. Morgan Chase. The deal was backed by $30 billion in emergency guarantees from the Federal Reserve.
That was the time when the administration could have come in and put in place various kinds of measures that would have reduced system risk.
The information I'm receiving from some entities is the end is not here, that there are other shoes to fall.
I've seen those investment banks working with the Fed and the SEC strengthen their liquidity, strengthen their capital positions. I get reports all the time. Our regulators are very vigilant.
On September 7th, 2008, Henry Paulson announced the federal takeover of Fannie Mae and Freddie Mac, two giant mortgage lenders on the brink of collapse.
Nothing about our actions today in any way reflects a changed view of the housing correction or the strength of other U.S. financial institutions.
2 days later, Lehman Brothers announced record losses of $3.2 billion, and its stock collapsed.
The effects of Lehman and AIG in September still came as a surprise. I mean, this is even after July and Fannie and Freddie. So clearly there was stuff that as of September, major stuff that nobody knew about.
I think that's fair.
Bear Stearns was rated AAA like a month before it went bankrupt?
More likely A2.
A2?
Yeah.
Okay. A2 is still not bankrupt.
No. It's a high investment grade, solid investment grade rating. Lehman Brothers A2 within days of failing. AIG AA within days of being bailed out. Fannie Mae and Freddie Mac were AAA when they were rescued. Citigroup, Merrill, all of them had investment grade ratings.
How can that be?
Well, that's a good question. That's a great question.
At no point did the administration ever go to all the major institutions and say, this is serious, tell us what your positions are, no bullshit, where are you?
Mm-hmm. Well, first, that's what the regulators, it's their job, right? Their job is to understand the exposure across these different institutions, and they have a very refined understanding that I think became more refined as the crisis proceeded. So,
forgive me, but that's clearly not true. I mean,
what do you mean it's not true?
In August of 2008, were you aware of the credit ratings held then by Lehman Brothers, Merrill Lynch, AIG, and did you think that they were accurate?
Well, certainly by that time, it was always clear that earlier credit ratings weren't accurate because they had been downgraded substantially.
No, they hadn't.
There was still some downgrading in terms of the industry and concerns. And certainly the stock price.
Not some. All those firms were rated at least A2 until a couple of days before they were rescued.
Well, then the answer is I just don't know enough to really answer your question on this particular issue.
Governor Fred Mishkin is resigning effective August 31. He says he plans to return to his teaching post at Columbia's Graduate School of Business.
Why did you leave the Federal Reserve in August of 2008? I mean, in the middle of the worst financial crisis.
I had to revise a textbook.
His departure leaves the Fed board with 3 of its 7 seats vacant, just when the economy needs it most.
Well, I'm sure your textbook is important and widely read, but in August of 2008, some somewhat more important things were going on in the world, don't you think?
By Friday, September 12th, Lehman Brothers had run out of cash, and the entire investment banking industry was sinking fast. The stability of the global financial system was in jeopardy. That weekend, Henry Paulson and Timothy Geithner, president of the New York Federal Reserve, called an emergency meeting with the CEOs of the major banks in an effort to rescue Lehman. But Lehman wasn't alone. Merrill Lynch, another major investment bank, was also on the brink of failure. And that Sunday, it was acquired by Bank of America. The only bank interested in buying Lehman was the British firm Barclays. But British regulators demanded a financial guarantee from the U.S. government. Paulson refused.
We all jumped into a yellow cab and went down to the Federal Reserve Bank. They wanted the bankruptcy case commenced before midnight of September 14. We kept pressing that this would be a terrible event. And at some point, I used the word Armageddon, and they fully considered the consequences of what they were proposing. The effect on the market would be extraordinary.
You said this?
Yes. They just said they had considered all of the comments that we had made, and they were still of the belief that in order to calm the markets and move forward, it was necessary for Lehman to go into bankruptcy.
Calm the markets?
Yes.
When were you first told that Lehman, in fact, was going to go bankrupt?
After the fact.
After the fact? Mm-hmm. Wow. Okay. And what was your reaction when you learned of it?
Holy cow.
Paulson and Bernanke had not consulted with other governments and didn't understand the consequences of foreign bankruptcy laws.
Lehman Brothers London continued to empty their
Under British law, Lehman's London office had to be closed immediately.
All transactions came to a halt, and there are thousands and thousands and thousands of transactions.
The hedge funds who had assets with Lehman in London discovered overnight, to their complete horror, that they couldn't get those assets back.
One of the points of the hub failed, and that had huge knock-on effects around the system.
The oldest money market fund in the nation wrote off roughly $750 million in bad debt issued by the now bankrupt Lehman Brothers.
Lehman's failure also caused a collapse in the commercial paper market, which many companies depend on to pay for operating expenses such as payroll.
That means maybe they have to lay off employees. They can't buy parts. It stops business in its tracks.
Suddenly, people stood and said, listen, what can we believe in? There's nothing we can trust anymore.
That same week, AIG owed $13 billion to holders of credit default swaps, and it didn't have the money.
AIG was another hub. If AIG had stopped, all planes may have to be, stop flying.
On September 17th, AIG is taken over by the government. And one day later, Paulson and Bernanke asked Congress for $700 billion to bail out the banks.
We're coming together.
They warned that the alternative would be a catastrophic financial collapse.
It was scary, the entire system froze up. Every part of the financial system, every part of the credit system, nobody could borrow money. There was like a cardiac arrest of the global financial system.
I'm playing the hand that was dealt me. A lot of what I'm dealing with, I'm dealing with the consequences of things that were done often many years ago.
Secretary Paulson spoke throughout the fall and all the potential root causes of this, and there are plenty. He called them. So I'm not sure.
You're not being serious about that, are you?
I am being serious. What would you have expected? What were you looking for that you didn't see?
He was the senior advocate for prohibiting the regulation of credit default swaps and also lifting the leverage limits on the investment banks.
So again,
he mentioned those things. I never heard him mention those things.
Could we turn this off for a second?
When AIG was bailed out, the owners of its credit default swaps, the most prominent of which was Goldman Sachs, were paid $61 billion the next day. Paulson, Bernanke, and Tim Geithner forced AIG to pay 100 cents on the dollar, rather than negotiate lower prices. Eventually, the AIG bailout cost taxpayers over $150 billion.
$160 billion went through AIG, $14 billion went to Goldman Sachs.
At the same time, Paulson and Geithner forced AIG to surrender its right to sue Goldman and the other banks for fraud.
Isn't there a problem when the person in charge of dealing with this crisis is the former CEO of Goldman Sachs, someone who had a major role in causing it?
Well, I think it's fair to say that the financial markets today are incredibly complicated.
And supply urgently needed money.
On October 4th, 2008, President Bush signs a $700 billion bailout bill. But world stock markets continue to fall amid fears that a global recession is now underway. The bailout legislation does nothing to stem the tide of layoffs and foreclosures. Unemployment in the United States and Europe quickly rises to 10%. The recession accelerates and spreads globally.
I began to get really scared because I hadn't foreseen the whole world going down at the same rate at the same time.
By December of 2008, General Motors and Chrysler are facing bankruptcy. And as U.S. consumers cut back on spending, Chinese manufacturers see sales plummet. Over 10 million migrant workers in China lose their jobs.
At the end of the day, the poorest, as always, pay the most.
Here you can earn a lot of money, like 70, 80 US dollar per month. As a farmer in the countryside, you cannot earn so much money. The workers, they just wire the salary to the hometown to give them family. The crisis started in America. We all know it will be coming to China. Some factories try to cut off some workers. And some people get poor because they lose the job. The lives get harder.
We were growing at about 20%. It was a super year. And then we suddenly went to -9 this quarter. Exports collapsed. And we're talking like 30%. So we just took a hit, fell off a cliff. Boom.
Even as the crisis unfolded, we didn't know how wide it was going to spread or how severe it was going to be. And we were still hoping that there would be some way for us to have a shelter and be less battered by the storm. But it's not possible. It's a very globalized world. The economies are all linked together.
Every time a home goes into foreclosure, it affects everyone who lives around that house. Because when that property goes on the market, it's going to be sold at a lower price. Maybe before it goes on the market, it won't be well maintained. We estimate another 9 million homeowners will lose their homes.
Salimos un fin de semana a mirar qué casas estaban de venta. Miramos una, el pago iba a ser de $3,200. Muy bonita la casa, el pago bajo, todo era, sacamos la lotería, pero la realidad fue cuando llegó el primer pago. Y yo en lo personal me sentía muy mal con mi esposo, porque trabaja demasiado y tenemos 3 hijos.
The vast majority I've seen lately, unfortunately, are people who've just been hurt by the economy. They were living, day to day, paycheck to paycheck, and unfortunately that ran out. And unemployment isn't going to pay a house mortgage. It's not going to pay a car bill.
I was a log truck driver, and they shut down all the logging systems up there, shut down the sawmills and everything. So I moved down here on a construction job, and the construction job got shut down too. So things are so tough. There's a lot of people out there, and pretty soon you're going to be seeing more camps like this around because there's just no jobs right now.
When the company did well, we did well. When the company did not do well, sir, we did not do well.
The men who destroyed their own companies and plunged the world into crisis walked away from the wreckage with their fortunes intact. The top 5 executives at Lehman Brothers made over $1 billion between 2000 and 2007. And when the firm went bankrupt, they got to keep all the money.
The system worked.
It doesn't make any sense for us to make a loan that's going to fail because we lose. They lose, the borrower loses, the community loses, and we lose.
Countrywide CEO Angelo Mozillo made $470 million between 2003 and 2008. $140 million came from dumping his Countrywide stock in the 12 months before the company collapsed.
Ultimately, I hold the board accountable when a business fails, because the board is responsible for hiring and firing the CEO and overseeing big strategic decisions. The problem with board composition in America is the way boards are elected. The boards are pretty much, in many cases, picked by the CEO.
The board of directors and the compensation committees are the 2 bodies best situated to determine the pay packages for executives. How do you think they've done over the past 10 years? Well, I think that if you look at those, I would give about a B. Because a B, yes.
Not an F.
Not an F, not an F.
Stan O'Neill, the CEO of Merrill Lynch, received $90 million in 2006 and 2007 alone. After driving his firm into the ground, Merrill Lynch's board of directors allowed him to resign, and he collected $161 million in severance.
Instead of being fired, Stan O'Neill is allowed to resign and takes away $151 million. That's a decision that board of directors made at that point.
And what grade do you give that decision?
That's a tougher one. I don't know if I would give that one a B as well.
O'Neill's successor, John Thain, was paid $87 million in 2007. And in December of 2008, 2 months after Merrill was bailed out by U.S. taxpayers, Thain and Merrill's board handed out billions in bonuses. In March of 2008, AIG's financial products division lost $11 billion. Instead of being fired, Joseph Cassano, the head of AIG FP, was kept on as a consultant for $1 million a month.
And you want to make sure that the key players and the key employees within AIGFP, we retain that intellectual knowledge.
I attended a very interesting dinner organized by Hank Paulson a little more than 1 year ago. With some officials and a couple of CEOs from the biggest banks in the U.S. And surprisingly enough, all these gentlemen were arguing we were too greedy, so we have part of responsibility, fine. And then they were turning to the Treasurer, to the Secretary of the Treasury, and say, you should regulate more because we're too greedy. We can't avoid it. So the only way to avoid this is to have more regulation.
I have spoken to many bankers about this question, including very senior ones. And this is the first time that I've ever heard anybody say that they actually wanted their compensation to be regulated in any way.
Yeah, because it was at the moment where they were afraid. And after, when solution to the crisis began to appear, then probably they changed their mind.
In the U.S., the banks are now bigger, more powerful, and more concentrated than ever before.
There are fewer competitors. A lot of smaller banks have been taken over by big ones. JP Morgan today is even bigger than it was before.
JP Morgan took over first Bear Stearns and then WAMU. Bank of America took over Countrywide, Merrill Lynch. Wells Fargo took over Wachovia.
After the crisis, the financial industry, including the Financial Services Roundtable, worked harder than ever to fight reform. The financial sector employs 3,000 lobbyists, more than 5 for each member of Congress.
Do you think the financial services industry has excessive political influence in the United States?
No. I think that every person in the country is represented here in Washington.
And you think that all segments of American society have equal and fair access to the system?
You can walk into any hearing room that you would like. Yes, I do.
One can walk into any hearing room. One cannot necessarily write the kind of lobbying checks that your industry writes or engage in the level of political contributions that your industry engages in.
Between 1998 and 2008, the financial industry spent over $5 billion on lobbying and campaign contributions. And since the crisis, they're spending even more money. The financial industry also exerts its influence in a more subtle way, one that most Americans don't know about. It has corrupted the study of economics itself.
Deregulation had tremendous financial and intellectual support because people argued it for their own benefit. The economics profession was the main source of that illusion.
Since the 1980s, academic economists have been major advocates of deregulation and played powerful roles in shaping U.S. government policy. Very few of these economic experts warned about the crisis. And even after the crisis, many of them opposed reform.
The guys who taught these things tended to get paid a lot of money being consultants. Business school professors don't live on a faculty salary. They do very, very well.
Over the last decade, the financial services industry has made about $5 billion worth of political contributions in the United States. It's kind of a lot of money. That doesn't bother you?
No.
Martin Feldstein is a professor at Harvard and one of the world's most prominent economists. As President Reagan's chief economic advisor, he was a major architect of deregulation. And from 1988 until 2009, he was on the board of directors of both AIG and AIG Financial Products, which paid him millions of dollars.
You have any regrets about having been on AIG's board?
I have no comments. No, I have no regrets about being on AIG's board.
None?
That I consider absolutely not. Absolutely not.
Okay. You have any regrets about AIG's decisions?
I cannot say anything more about AIG.
I've taught at Northwestern and Chicago, Harvard, and Columbia.
Glenn Hubbard is the Dean of Columbia Business School and was the chairman of the Council of Economic Advisors under George W. Bush.
Do you think the financial services industry has too much political power in the United States?
I don't think so, no. You certainly wouldn't get that impression by the drubbing that they regularly get in Washington.
Many prominent academics quietly make fortunes while helping the financial industry shape public debate and government policy. The Analysis Group, Charles River Associates, Compass Lexicon, and the Law and Economics Consulting Group manage a multi-billion-dollar industry that provides academic experts for hire. Two bankers who used these services were Ralph Ciaffi and Matthew Tannen, Bear Stearns hedge fund managers prosecuted for securities fraud. After hiring the analysis group, both were acquitted. Glenn Hubbard was paid $100,000 to testify in their defense.
Do you think that the economics discipline has a conflict of interest problem?
I'm not sure I know what you mean.
Do you think that a significant fraction of the economics discipline, number of economists, have financial conflicts of interest that in some way might call into question or color?
Oh, I see what you're saying. I doubt it. Most academic economists, aren't wealthy business people.
Hubbard makes $250,000 a year as a board member of MetLife and was formerly on the board of Capmark, a major commercial mortgage lender during the bubble, which went bankrupt in 2009. He has also advised Nomura Securities, KKR Financial Corporation, and many other financial firms. Laura Tyson, who declined to be interviewed for this film, is a professor at the University of California, Berkeley. She was the chair of the Council of Economic Advisors and then director of the National Economic Council in the Clinton administration. Shortly after leaving government, she joined the board of Morgan Stanley, which pays her $350,000 a year. Ruth Simmons, the president of Brown University, makes over $300,000 a year on the board of Goldman Sachs. Larry Summers, who as Treasury Secretary played a critical role in the deregulation of derivatives, became president of Harvard in 2001. While at Harvard, he made millions consulting to hedge funds and millions more in speaking fees, much of it from investment banks. According to his federal disclosure report, Summers' net worth is between $16.5 million and $39.5 million. Frederick Mishkin, who returned to Columbia Business School after leaving the Federal Reserve, reported on his federal disclosure report that his net worth was between $6 million and $17 million.
In 2006, you co-authored a study of Iceland's financial system.
Right.
Iceland is also an advanced country with excellent institutions, low corruption, rule of law. The economy has already adjusted to financial liberalization, while prudential regulation and supervision is generally quite strong.
Yeah, and that was the mistake. That turns out that that the prudential regulation and supervision was not strong in Iceland, and particularly
so what
during
led
this
you
period,
to think that it was?
I think that you're going with the information you had, and generally the view was that Iceland had very good institutions. It was a very advanced country.
Who told you that? What kind of research did you do?
You talk to people. You have faith in the central bank, which actually did fall down on the job. Clearly, this.
Why do you have faith in a central bank?
Well, that faith because you go with the information you have.
How much were you paid to write it?
I was paid. I think the number was. It's public information.
On your CV, the title of this report has been changed from Financial Stability in Iceland to Financial Instability in Iceland.
Oh, well, I don't know. Whatever it is the thing. If it's a typo, there's a typo.
I think what should be publicly available is whenever anybody does research on a topic that they disclose if they have any financial conflict with that research.
But if I recall, there is no policy to that effect.
I can't imagine anybody not doing that. In terms of putting it in a paper, there would be significant professional sanction for failure to do that.
I didn't see any place in the study where you indicated that you had been paid by the Icelandic Chamber of Commerce to produce it.
No, I don't,
Okay.
Richard Portis, the most famous economist in Britain and a professor at London Business School, was also commissioned by the Icelandic Chamber of Commerce in 2007 to write a report which praised the Icelandic financial sector.
The banks themselves are highly liquid. They've actually made money on the fall of the Icelandic krona. These are strong banks. Their funding, their market funding is assured for the coming year. These are well-run banks. Richard, thank you so much.
Like Mishkin, Portis's report didn't disclose his payment from the Icelandic Chamber of Commerce.
Does Harvard require disclosures of financial conflict of interest in publications?
Not to my knowledge.
Do you require people to report the compensation they've received from outside activities?
No.
Don't you think that's a problem?
I don't see why.
Martin Feldstein being on the board of AIG, Laura Tyson going on the board of Morgan Stanley, Larry Summers making $10 million a year consulting to financial services firms. Irrelevant.
Yeah, basically irrelevant.
You've written a very large number of articles about a very wide array of subjects. You never saw fit to investigate the risks of unregulated credit default swaps?
I never did.
Same question with regard to executive compensation, the regulation of corporate governance, the effect of political contributions.
I don't know that I would have anything to add to those discussions.
I'm looking at your resume now. It looks to me as if the majority of your outside activities are consulting and directorship arrangements with the financial services industry. Would you not agree with that characterization?
No, to my knowledge, I don't think my consulting clients are even on my CV, so no.
Who are your consulting clients?
I don't believe I have to discuss that with you.
Okay.
In fact, you have a few more minutes and the interview's over.
Do you consult for any financial services firms?
The answer is I do. But I do not want to go into details about that.
Do they include other financial services firms?
Possibly.
You don't remember?
This isn't a deposition, sir. I was polite enough to give you time. Foolishly, I now see. But you have 3 more minutes. Give it your best shot.
In 2004, at the height of the bubble, Glenn Hubbard co-authored a widely read paper with William C. Dudley, the chief economist of Goldman Sachs. In the paper, Hubbard praised credit derivatives and the securitization chain, stating that they had improved allocation of capital and were enhancing financial stability. He cited reduced volatility in the economy and stated that recessions had become less frequent and milder. Credit derivatives were protecting banks against losses and helping to distribute risk.
A medical researcher writes an article saying, to treat this disease, you should prescribe this drug. Turns out doctor makes 80% of personal income from manufacture of this drug. Does not bother you?
I think it's certainly important to disclose well, I think that's also a little different from cases that we're talking about here because
So, what do you think this says about the economics discipline?
Well, I mean, it has no relevance to anything, really. And indeed, I think it's it's an important part of the problem.
The rising power of the U.S. financial sector was part of a wider change in America. Since the 1980s, the United States has become a more unequal society, and its economic dominance has declined. Companies like General Motors, Chrysler, and U.S. Steel, formerly the core of the U.S. economy, were poorly managed and falling behind their foreign competitors. And as countries like China opened their economies, American companies sent jobs overseas to save money.
For many, many years, the 660 million people in the developed world were effectively sheltered from all of this additional labor that existed on the planet. Suddenly, the bamboo curtain and the iron curtain are lifted, and you have 2.5 billion additional people.
American factory workers were laid off by the tens of thousands.
Our manufacturing base was destroyed literally over the course of a few years.
As manufacturing declined, other industries rose. The United States leads the world in information technology, where high-paying jobs are easy to find. But those jobs require an education. And for average Americans, college is increasingly out of reach. While top private universities like Harvard have billions of dollars in their endowments, funding for public universities is shrinking, and tuition is rising. Tuition for California's public universities rose from $650 in the 1970s to over $10,000 in 2010. Increasingly, the most important determinant of whether Americans go to college is whether they can find the money to pay for it. Meanwhile, American tax policy shifted to favor the wealthy.
When I first came to office, I thought taxes were too high, and they were.
The most dramatic change was a series of tax cuts designed by Glenn Hubbard, who at the time was serving as President Bush's chief economic advisor. The Bush administration sharply reduced taxes on investment gains, stock dividends, and eliminated the estate tax.
We had a comprehensive plan that, when acted, has left nearly $1.1 trillion in the hands of American workers, families, investors, and small business owners.
Most of the benefits of these tax cuts went to the wealthiest 1% of Americans.
And by the way, it was really the cornerstone in many ways of our economic recovery policy.
Inequality of wealth in the United States is now higher than in any other developed country. American families responded to these changes in two ways: by working longer hours and by going into debt.
As the middle class falls further and further behind, there is a political urge to respond by making it easier to get credit.
You don't have to have a lousy home. The low-income home buyer can have just as nice a house as anybody else.
American families borrowed to finance their homes, their cars, their health care, and their children's educations.
People in the bottom 90% lost ground between 1980 and 2007. It all went to the top 1%.
For the first time in history, average Americans have less education and are less prosperous than their parents.
The era of greed and irresponsibility on Wall Street and in Washington has led us to a financial crisis as serious as any that we faced since the Great Depression.
When the financial crisis struck just before the 2008 election, Barack Obama pointed to Wall Street greed and regulatory failures as examples of the need for change in America.
A lack of oversight in Washington and on Wall Street is exactly what got us into this mess.
After taking office, President Obama spoke of the need to reform the financial industry.
We want a systemic risk regulator, increased capital requirements. We need a consumer financial protection agency. We need to change Wall Street's culture.
But when finally enacted in mid-2010, the administration's financial reforms were weak, and in some critical areas, including the rating agencies, lobbying, and compensation, nothing significant was even proposed.
Addressing Obama and, quote, regulatory reform, my response, if it was one word, would be, ha. There's very little reform.
How come?
It's a Wall Street government.
Obama chose Timothy Geithner as Treasury Secretary. Geithner was the president of the New York Federal Reserve during the crisis, and one of the key players in the decision to pay Goldman Sachs 100 cents on the dollar for its bets against mortgages.
When Tim Geithner was testifying to be confirmed as Treasury Secretary, he said, "I have never been a regulator." Now that said to me, he did not understand his job as president of the New York Fed.
The new president of the New York Fed is William C. Dudley, the former chief economist of Goldman Sachs, whose paper with Glenn Hubbard praised derivatives. Geithner's chief of staff is Mark Patterson, a former lobbyist for Goldman. And one of the senior advisors is Louis Sachs, who oversaw Tricadia, a company heavily involved in betting against the mortgage securities it was selling. To head the Commodity Futures Trading Commission, Obama picked Gary Gensler, a former Goldman Sachs executive who had helped ban the regulation of derivatives. To run the Securities and Exchange Commission, Obama picked Mary Shapiro, the former CEO of FINRA, the investment banking industry's self-regulation body. Obama's chief of staff, Rahm Emanuel, made $320,000 serving on the board of Freddie Mac. Both Martin Feldstein and Laura Tyson are members of Obama's Economic Recovery Advisory Board. And Obama's chief economic advisor is Larry Summers.
The most senior economic advisors are the very people who were there who built the structure.
None of us knew that Summers and Geithner were going to play major roles as advisors. First, I knew this was going to be status quo.
The Obama administration resisted regulation of bank compensation, even as foreign leaders took action.
I think the financial industry is a service industry. It should serve others before it serves itself.
In September of 2009, Christine Lagarde and the finance ministers of Sweden, the Netherlands, Luxembourg, Italy, Spain, and Germany called for the G20 nations, including the United States, to impose strict regulations on bank compensation. And in July of 2010, the European Parliament enacted those very regulations. The Obama administration had no response.
Their view is this is a temporary blip and things will go back to normal.
And that is why I am reappointing him to another term as chairman of the Federal Reserve. Thank you so much.
In 2009, Barack Obama reappointed Ben Bernanke.
Thank you, Mr. President.
As of mid-2010, not a single senior financial executive had been criminally prosecuted or even arrested. No special prosecutor had been appointed. Not a single financial firm had been prosecuted criminally for securities fraud or accounting fraud. The Obama administration has made no attempt to recover any of the compensation given to financial executives during the bubble.
I certainly would think of criminal action against some of Countrywide's top leaders like Mazzillo. I'd certainly look at Bear Stearns, Goldman Sachs, and Lehman Brothers, and Merrill Lynch.
For criminal prosecutions?
Yes.
Yes. In regard
They'd be very hard to win. But I think they could do it if they got enough underlings to tell the truth.
In an industry in which drug use, prostitution, and fraudulent billing of prostitutes as a business expense occur on an industrial scale, it wouldn't be hard to make people talk if you really wanted to.
They gave me a plea bargain and I took it. They were not interested in any of my records. They weren't interested in anything.
They were not interested in your records?
That's correct. That's correct.
There's a sensibility that you don't use people's personal vices in the context of Wall Street cases necessarily to get them to flip. I think maybe it's after the cataclysms that we've been through, maybe people will reevaluate that. I'm not the one to pass judgment on that right now.
You come to us today telling us we're sorry, we didn't mean it, we won't do it again. Trust us. Well, I have some people in my constituency that actually robbed some of your banks. And they say the same thing. They're sorry, they didn't mean it, they won't do it again.
In 2009, as unemployment hit its highest level in 17 years, Morgan Stanley paid its employees over $14 billion, and Goldman Sachs paid out over $16 billion. In 2010, bonuses were even higher.
Why should a financial engineer be paid four times to 100 times more than a real engineer? A real engineer build bridges, and a financial engineer build dreams. And when those dreams turn out to be nightmares, other people pay for it.
For decades, the American financial system was stable and safe. But then something changed. The financial industry turned its back on society, corrupted our political system, and plunged the world economy into crisis. At enormous cost, we've avoided disaster and are recovering. But the men and institutions that caused the crisis are still in power, and that needs to change. They will tell us that we need them, and that what they do is too complicated for us to understand. They will tell us it won't happen again, They will spend billions fighting reform. It won't be easy. But some things are worth fighting for.